Hey guys, Stock Saturday. It's been a green week, about 4,000 up. The rest of my portfolio is actually underperforming the market, but I've been saved by my investment into CleanSpark, so that's gone quite well, which I will come back to. No other changes this week, although I am considering quite a few bits. But looking at some of the news. So I didn't cover this last month. One of my larger holdings in the other ISA, Atalaya Mining, my sort of pure copper play, aside from sort of things like Glencore being a bit more diversified. This is all in copper, which I'm sort of very bullish on for the long-term future, but sort of accepting that it could sort of drop a little in a recession and sort of in the near future. But it's something that I'm very bullish on for sort of the next 5 or 10 years. And they've announced their Q4 and full year results, as well as the 2023 outlook. Basically, the sort of headlines is that they had quite a good month on production, nearly 14,000 tonnes, and an all-in sustaining cost of $3.12. If you come over to the copper price, we're at sort of $4.11, so that's pretty good. It's about $1 in profit. And for the 2023 guidance, they're looking at 53 to 55,000 tonnes, which is sort of small compared to people like Glencore and other miners. Tiny, really, but obviously a very small market cap. So I'm pretty happy with that, and they're sort of doing some various cost reduction measures. They're building a small sort of solar plant so that they can get some of their own electricity, and sort of various new refining methods, the Elix Phase 1. So that's interesting, as well as sort of exploring new mines. They don't have the longest mine life, sort of still talking about 10 to 11 years left in their current mines, but they have expansion plans, of course. So yeah, all-in sustaining cost forecast of 3 to 320. So even if we get a bit of a pullback to the sort of lows of late last year, then they'll still be just about in profit. Probably be posting negative EPS with the sort of write-downs and non-cash stuff, but that's fair enough. And yeah, final dividend of 3.8 cents. So small dividend, but that'll go up in time with any luck. So yeah, not bad. Bit of a negative, bit of early news for anyone in sort of either TSMC or the wider semiconductor space, because a lot of them do use TSMC. So if their revenue is down, you can imagine semiconductors companies in particular haven't done all that well. So the monthly revenue was 15% down on last year's March. This first annual year-on-year decline they've had for a single month, admittedly, but first one they've had for about 4 years. Sort of 2019 time wasn't quite as good as 2018. And since then it's just rocketed up, and now we've got our first year-on-year decline. So have to keep an eye on it and see if it gets worse. But yeah, certainly they did forecast this, that sort of 2023 was going to be a middling average sort of year, maybe a small decline, maybe a small rise, depending on recession and that sort of thing. But yeah, it's not too good. Q1 should still be okay, and obviously they're way off their sort of all-time high share price, so yeah, maybe just a bit quiet, but might be something to sort of watch out for your AMDs and your Nvidias and people like them, and Qualcomm and all the other sort of niche semiconductor companies. But yeah, we'll have to see where this goes. This was an interesting one. Prosus, my sort of proxy on Tencent, is selling more shares of Tencent and buying back their own stock. They had sort of indicated that they were doing this, but I hadn't realised quite so aggressively. They've sort of been selling like 1% of their stake, 2% maybe every year, and they're sort of wanting to close the discount between sort of their shares and the total value of their assets, because there is still quite a bit of discount. So yeah, they're looking at, or so they've repurchased 1.78 million process shares, and they are looking to deposit 96 million Tencent shares, presumably to sell all of those, and that is quite a bit of their stake. So come over to they give you quite a handy net asset value breakdown on their holdings, and yeah, they hold 2.5 billion shares of Tencent. So 96 million is a reasonable sort of portion of that to be doing in maybe probably not in one go, but sort of over a time. And yeah, that seems to be sort of weighing on both of their share prices, really. People don't like that they're becoming less of a proxy on Tencent, so sort of selling process shares a little, and Tencent are going down because process are selling shares, and then that drops the process share price because Tencent is going down. So it's a little bit of a sort of downward spiral that sort of can get a little bit out of control, but yeah, interesting. So it's still, process are like €66, and net asset value of all of this, if you include all the unlisted businesses and that sort of thing, is still €108. So they're still a way off their net asset value, and I'll continue to hold, but people have sort of commented that the more they sell of Tencent, the more process becomes sort of a bet on, online food delivery and classified listings companies and that sort of thing, rather than just a proxy on Tencent. So yeah, interesting to keep a watch on what happens with this. And then the news, quite a bit of news this week. So Tuesday, you had some quite poor retail sales data for the EU. Was a little bit better than expected, but still not good. Sort of year on year retail sales 3% down, down for the month as well. And then UK mortgage rate was expected to be sort of slightly down on last month at 7%, and that's now 7.22%. Not sure whether this is sort of an average across the board, including sort of 2-year fixes and variables and even standard variable rate, but I don't really see 7.2% mortgages on the market, so not entirely sure where this comes from. I know people have been sort of paying a lot more on the standard variable rate, so if you let your fix run to an end and then don't do anything, you get pushed onto standard variable rate, which is appalling. So yeah, maybe if that's what they're taking. I know there's millions of people in the UK on that, unfortunately, because they don't switch, or they don't even know to switch. And then we had the CPI data, the big day on Wednesday. So everyone's sort of focusing on the headlines of the annual year-on-year main CPI coming down from 6% last month to 5%, which was lower than even expected. It's expected to drop, so 5.2%. So to drop a full 1% was sort of fairly big, but this is largely energy prices, and I always say, unless he's changed his mind, this is not what Jerome Powell focuses on. He looks at core, and he's sort of been mentioning that at the last sort of few meetings. So look at core, it was all sort of as expected, which actually is a rise. The year-on-year figure has gone up since last month, so would imagine he's not going to think too much of this, and I don't know whether we'll get another interest rate rise, but he's certainly not going to be saying, we're done, as the sort of people are saying, looking at the ordinary figure, or inflation's tanking. It's just energy prices, which could easily rebound upwards. So he looks at core. and core is not looking great. Well, that's interesting. UK construction output very much better than expected, 5.7% up on last February, and very much up on last month. So not too bad. I am in the construction industry, so good. GDP 0%, so maybe the rest of the country isn't doing quite so well. So we got manufacturing production flat, so it is just construction that is doing well, it seems. Jobless claims and things sort of pretty much as expected. Then lastly, you had some very poor retail sales data for the US as well. So EU was looking bad, US is looking just as bad. And this is March, so it's the most up-to-date data. Basically everything was worse than expected and a lot worse than last month. So could be affecting your consumer staples companies and that sort of thing, consumer discretionary companies. A little bit of sort of advanced warning potentially. Some people could be in for a bit of bad earnings. So in the portfolio, not really too much change, as I say. I do have a bit of an interesting sort of issue with Stellantis. They go ex-dividend on the 20th, and I think the dividend for me would be about £950 before taxes and everything. So I'd lose 15% withholding tax on that, and then I would pay 8.75%, I believe, dividend tax in the UK. I think you can offset sort of some of that, but that's sort of, a couple £100 nearly. So I am considering, as I understand it, I can sell the day before ex-dividend and then buy back on the day of ex-dividend, and in theory the share price should drop by the dividend amount, and I can just put that sort of £950 into more shares and not have to pay any of the tax. It won't count as a sale because of the wash trading rule. So because I'm buying within 30 days again, it won't actually count as that I've sold. So interesting to sort of be looking this up, and I might have to be doing this going forward for sort of some of the bigger dividends, because that is the dividend allowance for this year, I believe, is £1,000. So £950 dividend is all of that gone within a couple of weeks of the new tax year. So and if you've done anything like this, or you're aware of anything that would sort of cause an issue, do let me know. So on the ISA side, I am kind of thinking this 3-year Treasuries position maybe is not the thing to be holding at the moment. I know I've sort of not had it that long, and I was kind of waiting for the sort of indication of a drop in interest rates, and this would go up. But just seeing sort of various things. The US, I just saw, posted a $384 billion deficit in March. So they've spent $384 billion more than they've brought in revenues, and I just think eventually they're going to have to start sort of increasing the debt ceiling and printing money to afford their bills, basically. I can't see it's getting too much better. Their sort of interest on the debt is going up, and so Treasuries basically, paying 4% and getting back the money that you put in, but being worth a lot less, doesn't seem all that appealing. So I have been sort of mentioning whether to sort of split this between Bitcoin miners and gold and silver miners and sort of anything else hard assets. I would sort of missed the chance to put it into CleanSpark. It's now up 50% since I bought, so it's been a reasonably good buy in the other ISA. So come over to the IG trading, actually 55% up on the IG ISA. So that was good. Switch from Hive blockchain. They're not up nearly as much. And $3,000 gain, over $3,000 already. So that's provided a lot of gain for the week. The sort of Chinese tech is down slightly. Alibaba back to negative news, and a negative share price, certainly Baidu sort of dropping a fair bit as well. Not something that I'm sort of looking to add to at the moment. But yeah, sort of considering 13,000 in bonds maybe isn't the way to go. So do leave your thoughts in the comments if you think I've maybe left it a bit too long for CleanSpark. If you saw my video, sort of potentially in a year or two looking at much bigger price than this. So do I just bite the bullet and accept $1.50 maybe less of a gain than sort of I would have had last week, but accept that I'm looking at hopefully $20, $30, $40 share price and buy in. And the silver miners I think still look reasonably okay. They're sort of up 5-10% on a week or two ago, so doesn't look horrendous. But yeah, that's the plan really. So this could change. I know I've said this lots and lots of times, but this could change quite a bit by next week. So leave your thoughts in comments below and like and subscribe. Oh, and join the free Discord, link down below. See you soon.